What is going on, guys and girls? Good morning, good evening, good afternoon. Welcome back to the channel. And in today's video, we are going to be covering high probability trade setups and how to find them. I'm going to give you guys some tips and tricks on some of the things I look for when I'm trying to scout for high probability trade setups. These are going to be relevant to me and my strategy, but there's some source in here, and that source can be applied to your strategy, whether you're a day trader, a swing trader, learning how to trade, finding your little niche, finding the groove that you're falling into, whatever. This can be applied to all of it. So with that being said, let's get straight into it and let's figure out how to find some high probability trade setups. So now, most traders don't have a bad strategy. They don't have a filter for when to use it. Every single candle looks like an opportunity, and that is your problem. Every single up-and-coming trader thinks that you need to sit down every day and trade every single day. This is the biggest misconception in the trading industry, and this is why most traders lose money. You don't have a filter for when to turn on and off your strategy. And when you have that, every single day when you sit down thinking, I need to take a trade, you find yourself taking a trade. That is your problem. Having one reason to enter is not enough. A single candle or a single signal is just a guess. You need to be stacking confluence. You need to be building a confirmation bias in order to take the trade. Otherwise, every single setup looks like a high probability setup, and it isn't. High probability setups have multiple confluence factors. They have multiple reasons for why you might be looking to get into this position. So for example, for me in my trading, that's structure, that's levels, that's additional confirmation, that might be fib retracements. For me, could be head and shoulders related patterns. That for me is a setup worth taking. One bullish candle, one bearish candle, one rejection, one support and resistance being flipped, that's not enough. I'm looking to stack confluence factors together. I'm looking to build a thesis and a narrative and a story around my trading. If I start removing these and I start leaving myself with only one or two signals for me to take the trade, then I'm just trading noise. I don't know what I'm actually taking. I'm not trading based on a strategy. I'm not stacking confluence. I'm just guessing. I see something, I like the look of it, and I'm guessing. That is not how you make money. That's not how you find high probability trading setups. So if you can't list multiple reasons why you should be in the trade, if you can't build multiple layers of confluence into your bias, into your thesis that you're developing as to why you should be getting into this position and risking money by taking this position, if you can't list a few of those, then there's probably no trade there and you should probably stay out. And I said it before, the biggest misconception is that you need to sit down and trade multiple times a day to make money, and that's not true. So in this case, patience is your friend. Patience is not weakness. Patience is actually the filter that will stop you from overtrading. Patience is the filter that will force you to look for more high probability setups. Patience is the filter that will allow you to build and stack multiple confluence factors in your favor before you even take the position. So for me, one of those other factors is to always trade with the market structure, not against it. So I'm a hybrid trader. I look at the higher time frames and then I harness that analysis and I take my entries based off the lower time frames. So what are the higher time frames telling me? If higher time frames is telling me we're in a bullish structure, we're making higher highs and higher lows, the higher time frame structure is in a bullish market trend, then I'm looking for longs. I would not necessarily want to be getting short when the higher time frame structure is bullish. Conversely, if the higher time frame structure is bearish, then I'm looking for shorts. I'm not actively looking to get long against the higher time frame bearish market structure. So one of the factors for me when I'm building and stacking confluence is higher time frame structure. Am I with the trend or am I against it? Now, counter trend trading exists. It's a very well-known strategy and it can be very profitable. But for me, I find that the probability of these setups starts to reduce. You've heard the age-old saying in trading, the trend is your friend. It's true. Fighting against a higher time frame trend typically carries a lower strike rate than trading with it. So for me, I don't like to fight the higher time frame trend. It means that the market has to be wrong. It means that I need to see something change in order for me to make money and in order for me to be right. And the chances of that tend to reduce. So for me, I'm always looking to trade with the higher time frame structure, with the higher time frame trend, not against it. So I set my directional bias on the daily, and then I will refine that down on the 4-hour and perhaps the 1-hour time frames. So I'm looking to build and stack multiple time frames together. The higher time frame is the parent. It's acting as my umbrella underneath my analysis. Am I with the trend or am I against the trend? Easy filter. When you're looking for high probability setups, this is an easy filter. Am I with the trend or am I against the trend? Yes or no? Now, not every single level is worth trading. If you have to hunt for it, it's probably not a level. Everybody likes to refer to trend lines, support and resistance, key breakouts, higher highs, higher lows. All that stuff is basic technical analysis, but it doesn't necessarily make it a significant level. Significant levels get tested. They tend to be well respected and they're obvious. If you've got your magnifying glass out and you're hunting around trying to find a 5-minute or a 30-minute or a 15-minute level that you think has got lots of confluence factors behind it, it's probably not there. It's probably not a level. There's a good example of this at the moment in the gold market. It's around 4,800. 4,800 is a key level for gold currently because it's being respected, it's being tested, and the market is having a reaction every time it goes to that level. It's clear. You can see it on the 4-hour, you can see it on the 1-hour, you can see it on the daily time frame. It's present on the weekly time frame. It's a very obvious level. If you have to search for something, there's a chance that it's probably not there. Again, previous swing highs and swing lows. These are major breakout zones. One of my strategies specifically focuses on major breakout zones of previous swing highs and swing lows. A few other factors which I use to build my bias and my analysis there, but that is one of my core strategies because typically these are levels that the whole market is watching and they carry more weight. They've got more emphasis behind them. When they get broken, especially if we've had multiple rejections of said level, when that level gets broken, we typically tend to have a reaction to that level. Doesn't mean that it's going to be the biggest trade in the world, but the market will respond to that level because it's a significant area, a previous swing high or a previous swing low. This is a major breakout zone. And lastly, the more times that a level has been tested, the more that level matters. For example, we can use the Bitcoin chart as a good example of this. Right now, the BTC chart is currently rejecting 76K. BTC has had a bit of a tough time respecting and reacting to 74 to 76K. There's two levels to keep an eye on. If you're trading crypto, some free source for you. Below 76K, not interested. Above 76K, interested. Have a look at how many times that level has been tested. Have a look at how many times we've had a failed attempt at breaking out of this level. Have a look at how many times this level has had a reaction, deceleration, a sweep, a breakout, and then acceptance back below. The more times that a level has been tested, the more that level matters, the more emphasis and lenience you can place on that level, either for a support and resistance flip once it gets broken, or another reaction to it. The bigger the move when that level finally breaks, that is one of my core strategies. I'm not going to give you guys my strategies for free on YouTube. If you want my strategies, you can join QT, but that is one of them. One of the ones we're talking about right now relates to my breakout strategy, and it's a very profitable strategy when used correctly. So the more times that a level has been tested, the more that level matters. Now, time frame alignment is non-negotiable. What does that mean? It means higher time frames set your bias and lower time frames trigger my entries. At least for me anyway, I'm a hybrid trader. So I wouldn't trade a 15-minute setup against the daily trend because for me, that's a low probability bet. I'm looking for A+ setups. I'm looking for higher time frame analysis, lower time frame execution, building, stacking, designing all my confluence factors together to give me this nice cake recipe that when I put it in the oven, it gives me the highest chance of success for that recipe making a good cake or a cookie or whatever you're making with it, right? All of the time frames should tell me a similar story. They should be telling you the same story. If the time frames are telling you that the daily looks bearish, the 4-hour looks bullish, the 15-minute you're excited about, the 5-minute you're not sure about, there's probably no trade. If you've got a bunch of discrepancies in your analysis and you're trying to find reasons to take the position, there's probably no trade. It's probably a day to sit on your hands. One of the best things you can do for building and designing confluence factors when it relates to this is to zoom out. Go up a time frame. If you're not sure, go up one. If you're on the 5-minute chart, go up to the 15. If you're living on the 15, go up to the 30. If you're on the 30 and you're not sure, go up to the 1-hour, then the 4-hour, then the daily. Whatever you need to do to give you a bigger picture. If you need to zoom out so that you can see things more clearly, then do that every single time. Knowing your invalidation point before you enter. When you're looking for high probability setups, you need to know where your invalidation is. This is actually not just your stop loss. So for example, the breakout trade on BTC over the weekend, 76K. I took that breakout trade. I had a stop loss below a certain level that I was looking to place my stop loss, which is where it was. However, I also had an invalidation because I'm trading a breakout level. I'm looking to have a level, e.g. 76K, like I told you guys before. I'm looking to have that level broken. So if we see any acceptance back below that level again, that tells me that my invalidation is moving up the priority list. Why? Because if I'm taking a breakout trade and I'm looking to get long on a breakout of a certain level, if that level is then subsequently lost and we have acceptance back below it, then the trade conditions under which I took the original position are no longer present. Doesn't mean that I manually close it. That's for you to decide as part of your trade management plan, which for me, we actually had an impulse higher and then retraced back. I'd already rolled my stops. I moved my stop loss to break even and I was tagged out for 0 on that position. Why? Because I'm cognizant of the fact that my invalidation is now being triggered because we've now lost the level that I took the breakout based on. Cool. So do I want to be in this position anymore? Well, not if I took it based on the breakout, because now the breakout's failed. So knowing your invalidation point before you enter, everybody needs a stop loss. That's fine. But you can also have an additional layer of confluence here, which is at what point do I no longer want to be in this position? At what point has my original trade thesis now been invalidated and I wish to exit this position? It's very insightful to define that for yourself before you enter the trade. Top tip. Patience is your highest probability tool. Most setups that look good on a Monday are clearer on a Wednesday. I said it at the start. Everybody thinks you've got to sit down and take 100 positions a week. That's not true. That's categorically not true. That's clickbait shit that the trading industry will sell you so that you perceivably need to sit down and trade every day. You might sit down and do a watch this on a Monday, and that position may not present itself until Wednesday afternoon or Wednesday evening. Waiting for confirmation is a good thing. It's not missing the trade. You're managing risk. You're loading up your sniper rifle with the bullets. You're checking out the wind, the air density, the humidity, etc., etc., etc. You're refining your target. By Wednesday, the target has presented itself in the crosshairs and you can take the shot. That's confirmation. That's patience. That's mechanical trading. That's high probability trade setups. That's not trigger happy, foot soldier on the ground with a machine gun letting off bullets everywhere. It's not that. You want to behave like a sniper. The market will always give you another setup. There will always be another trade. There is hundreds of high probability setups every single week in all different types of markets. There's always going to be another one. The trades that you force will end up costing you a lot more than the ones that you missed. If you missed a couple of trades last month, go over them, have a look at what you missed. Why did you miss it? Stand to learn something from it, journal about what you've learned from it, and then move on. Do the same thing for all the trades that you forced. I probably shouldn't have taken this, but I did anyway. And there's 6 of them last month. Go over it, review your performance. Sometimes less trades is better trades. This doesn't suit the day trading narrative, but being picky is a good thing. Less trades means better trades, and better trades means you're starting to become more of a mechanical trader. You're starting to look for more high probability setups. I have my criteria, it's set, it suits me, my lifestyle, my goals, my free time, the sessions that I trade, etc., 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 even my psychology. My trade management plan suits my personal psychology. So a piece of advice I would give to you is when you're building and designing your trade management plan, if that suits your psychology, you'll be able to execute on it easier. If it's the opposite to how you would psychologically behave, then you're going to struggle. So if you don't know what any of this means and you don't know what trade management is, then you should probably jump into QT and we'll show you how to do that. But if you already know what this is, then this is a good tip for you. Make your trade management psychologically easy on yourself so that you can execute it easier. Now, before every entry, ask yourself these questions. These are the questions that I ask myself. Is the structure on the higher time frame in my favor or against it? Am I trading with the higher time frame trend or am I not? Am I trading at a significant respected level? I gave you a couple of examples. 4,800 on gold, 76K on BTC. These are significant respected levels. Am I interested in something that isn't here? Personally, no. I'll wait. I'll be patient. Do I have at least 3 reasons to be in this trade? For me, it's actually a little more than 3, but you probably need at least 3 reasons to get into this position. Can you build and design and stack your confluence to support your trade bias? Do you have multiple reasons to get into this? Both positive, maybe you've got negative confluence factors. It's good to consider those too. Are all the relevant timeframes aligned? For me, I'm a hybrid trader. What do I see on the higher timeframes? Can I get an entry on the lower timeframes? Am I seeing this A+ setup? Do I have, again, multiple confluence factors here? or am I just taking it on a 5-minute time frame? Do I know exactly where my thesis is invalidated? I've got my stop loss set, I've got my TP set, but where am I looking to exit this position manually if my thesis is no longer valid, if the trade is now invalid? Do I know where that is? If all of these 5 are a yes, we move into phase 2, which is taking the position. If any of these is a no, then you either need to refine it, review it, or there's no trade. Simple. It's like a checklist. Do I have 5 ticks? Yes. Take the trade. Do I have 5 no's? Don't take the trade. Not happening. So, fewer trades, higher probability setups. Professional traders are selective. They're patient. They operate like a sniper. They're not active. They're not standing in the trenches with a machine gun firing bullets. Your goal is not to trade every single day. It is to trade well. It is to be patient. It is to be mechanical. It is to execute like a sniper. A week with 2 good setups beats a week with 10 average setups. You want 2 good trades that you were patient for, that you waited for, that you sized up properly, that you stacked all your confluence factors together for, and then you execute. Not 10 shit show trades. When you review them, 3 of them you think, what the hell was I doing? 2 of them you're like, that wasn't even valid. And then the other one I got lucky with, and there were 4 ones that met my trade plan. Okay, so 6 can probably go. Every bad trade doesn't cost you money, it costs you mental capital. Trading is a very difficult psychological journey. It is probably the hardest psychological thing I've ever done as a younger man. Don't make it harder than it needs to be. It costs you psychological load to overtrade, to undertrade, to overthink, to over-risk. All these things cost you psychological load. The best thing you can do is to free up some of your cognitive space, free up some mental load so that you can think clearer, so that you can execute clearer. Your job is to wait, and then it's to pull the trigger and execute without hesitation. If you want to see this live in the markets, you guys and girls know, quantum traders, mechanical trading community. We've got day traders, we've got swing traders, we've got hybrids, we've got crypto, we've got NASDAQ, we've got equities, we've got gold, we've got commodities, we've got it all. We've got weekly analysis applying these exact frameworks, these exact principles. 2 weekly webinars, 3 live trading sessions, mechanical entries, mechanical exits, high probability setups, patience, A+ style trades. We're practicing what we're preaching. Risk management is being built around high probability setups. We've got our membership option. We've got one-to-one coaching available. We've got it all. We're trying to redefine the way that the trading industry works. And one of the ways to do that is by doing this and by implementing this. And that's what we're doing in QT. As always, I'll leave some links in the description below. Down here somewhere, there'll be some links where you can watch some videos, find out a little bit more about QT, what's involved. And with that being said, the best traders are not the most active. They are the most patient. Keep it mechanical, and I will see you guys in the next video. Take care.